Welcome to the Deep Dive. Today our mission is really to cut through the noise around Herbalife's Q2 2025 earnings call.
Yeah, there's a lot to unpack.
We've synthesized the data, the commentary, the guidance, basically trying to give you a clear picture of a company that's attempting a pretty radical transformation.
It was definitely a complex quarter. Herbalife management, they delivered quite strongly on the profit side, beating consensus, showing real discipline on the P&L. But that strength, well, it got overshadowed pretty quickly, didn't it?
By the top line miss, yeah. And this huge strategic pivot they announced.
Exactly. And the market just reacted with, well, immediate skepticism. It signals the burden of proof is really on their forward story now.
And that skepticism, I think that's at the core of our deep dive today. Management's tone, it was confidently cautious, you could say.
Yeah, the CEO highlighted execution, talked about entering a pivotal new era.
Right, but then you saw the stock sell off pretty sharply the next day. The market clearly decided the current revenue challenge outweighs any promise of future efficiency.
Precisely. So let's maybe start with those headline numbers, the ones driving that disconnect.
Good idea.
Okay, so bottom line, definitely a beat. Adjusted earnings per share, $0.59. That was significantly better than the street's guess of around $0.53.
Okay.
And adjusted EBITDA also came in strong, $173.6 million, which beat their guidance. That shows a strong 13.8% margin. They're definitely keeping a tight rein on costs.
So the efficiency part of the story holds up. Where did the growth narrative stumble then? What caused that sell-off?
Yeah, it was the top line. Revenue was $1.259 billion.
Which missed estimates slightly.
Just slightly, yeah. Consensus was around $1.27 billion. But reported sales were down 1.7% compared to last year. Now, digging into the balance sheet a bit, operational cash flow looked quite good, $96 million.
Right, and that easily covered their capital expenditures, which were what, about $23 million?
$22.8 million, yeah. So that's a positive for their liquidity, especially as they're trying to manage that debt load.
Okay, so let's unpack this strategic pivot now, because this sounds like where the company is fundamentally trying to change.
It really is. The CEO is pushing Herbalife away from just being a distribution company.
Towards
What did they call it?
a digitally augmented product innovation plus productivity model.
Catchy.
Yeah. The goal is ambitious, though. Become the premier health and wellness company, community, and platform.
So it's not just tweaking things around the edges.
No, definitely not. It's an operational overhaul, maybe even a cultural one. And this whole multi-year plan really hangs on two big things.
Which are?
Integrating a digital platform and shifting revenue towards subscriptions through new products.
Okay, let's talk platform first. The Pro2col app.
Yes, that's the key launch. It's AI-assisted.
Right. But if this digitally augmented model is the future, why did North America only just see its first volume growth month since way back in 2021? Isn't that a bit late?
That's a totally fair question. And it's exactly why the market is skeptical, right?
The Pro2col app, though, is the mechanism they hope will fix those deeper issues. They did a beta rollout to over 7,000 distributors in North America.
And uptake was good.
Better than expected, actually. About 50% higher sign-up than they planned for. This app is trying to tackle the biggest historical headache of direct selling.
Distributor churn.
Exactly, and the high friction involved.
So how does an app solve that? It tracks progress, okay, but what's this proto score they mentioned?
The Proto score. This is basically the key metric for distributors now. Think of it as a personalized KPI for efficiency and retention.
Okay.
It measures productivity by looking at outreach activity, the variety of products they offer, and crucially, customer retention rates. It gives distributors a tangible, data-driven way to see how they're doing.
Something they didn't have before.
Not really, not at this level. For 45 years, the company was sort of flying blind at the end customer level. Now they have a specific metric for improvement.
And the data they're collecting.
Yeah.
They mentioned 140,000 data points already from the beta.
Yeah, in a really short time.
How valuable is that, really? Is it just more noise or truly proprietary?
Well, they'd argue it buys them superior vertical integration. This isn't just website traffic.
Right.
It's granular, personalized health data tied directly to their products, their outcomes within their ecosystem. It's insight into distributor habits and customer consumption they couldn't get otherwise.
So the idea is customize recommendations, sales strategies.
Immediately.
Yeah.
If this app can just nudge down distributor churn or nudge up customer lifetime value even a bit, the whole volume picture could change.
And they're pairing that platform push with new products designed for recurring revenue.
Absolutely. Two big ones. MultiBurn, which is a non-pharmaceutical weight loss supplement. Management says early sales are outpacing expectations.
Okay.
And then a healthy lifespan product focusing on cellular health. It uses a patent ingredient, a niogen, to boost NAD levels.
And the key change here is the business model.
Yes, the monetization.
Right.
These new products are built around subscriptions. They want that predictable, recurring revenue stream.
Moving away from just relying on transactional volume.
Exactly. Which has historically been pretty unreliable for them.
Okay, let's swing back to the overall financials for a sec. That top line again, reported sales down 1.7%.
All right.
But they said constant currency sales were flat.
Right. That difference, the 1.7%, was purely down to a big foreign exchange headwind, about 170 basis points worth.
So if the dollar hadn't strengthened against other currencies?
Their sales would have been flat year over year, but the core issue, the real problem, is still volume. Globally, volume is down 3.1%.
So volume is still the big challenge. But they did say pricing helped offset some of that.
Yeah, favorable pricing across different markets was a significant help.
Okay, but is there any sign this digital pivot, the Pro2col app, is actually starting to help volume yet?
There is one hopeful sign, actually. They specifically highlighted North America,
which saw volume growth in July.
Yes, its first month of year-over-year volume growth since way back in April 2021. And management ties that directly to the momentum from MultiBurn and the Pro2col beta. Now it's just one region, 1 month.
Small green shoot.
Exactly. But it's the kind of inflection point the market desperately needs to see repeated globally.
Okay, now let's tackle the guidance. Management seemed confident enough to raise the full-year outlook.
They did.
Is that based on hoping volume picks up? Or is it just them being better at controlling costs than expected?
It's definitely the efficiency providing the safety net, I'd say. But the guidance does imply they think volume will at least stabilize.
So what are the new numbers?
They raised full-year recorded net sales guidance. The new range is -1.0% to +3.0%. That's tightening and raising the bottom end from before.
And EBITDA.
Crucially, yes. Raised adjusted EBITDA guidance to $640 million to $660 million. That's up from $655 million.
Okay, and they lowered spending too.
Yeah, cut the full-year CapEx guidance. Now $705 million to $95 million, down from $120 million. Signals better capital allocation, maybe.
But there's a catch, isn't there? Something about foreign exchange movements and why the EBITDA raise wasn't even higher.
Yes, this is a really critical point for understanding investor reaction. Why aren't the recent favorable FX moves showing up more in the Q3 and Q4 EBITDA guidance?
Right.
The CFO explained it's because of inventory. There's a significant lag.
Meaning
the inventory they're selling now and will sell in the near term was bought earlier at the less favorable FX rates. Those costs were locked in.
Ah, okay, so the benefit of the current, better exchange rates.
Won't fully hit the EBITDA line until Q1, maybe even Q2 of 2026.
So that's quite a lag.
It is. And it's a major reason why investors might just see the raised guidance as cost control, not reflecting any real underlying improvement yet.
Okay, so while everyone waits for those potential FX tailwinds way off in 2026, let's look at something management is tackling right now, the balance sheet, deleveraging.
Yeah, they're clearly focused on cutting debt. They redeemed $50 million of those expensive 7.875% notes that were due in 2025. They did that back in June.
Shows commitment to the long-term target.
Absolutely. Their goal is to get debt down to $1.4 billion by 2028. The leverage ratio held steady at 3.0x total leverage.
And they're paying off the rest of those 2025 notes soon.
Confirmed they'll pay off the remaining $147 million before they mature in September. De-risking those near-term maturities is definitely a positive for equity holders long-term.
Okay, so let's pull it all together. We've got an EPS beat, raised EBITDA guidance, progress on debt reduction, a major digital pivot underway. But the market reaction was negative. Why the disconnect?
Fundamentally, the market is punishing that revenue miss and the fact that overall volume is still declining.
Right.
Investors seem to view the raised guidance as relying too much on cost control, kind of the old playbook for beating estimates, rather than proof that this new model is actually driving organic growth at the top line.
And analysts are cautious too.
Yeah, you see firms like Mizuho sticking with a neutral rating. They acknowledge the digital push, sure, but they also stress that Herbalife operates against a tough backdrop for consumer staples generally. You know, the XLP ETF hasn't been doing great.
So the real deciding factors, the swing factors, are all about the future then.
Entirely. Near term, you've got to watch the full commercial launch of Pro2col in Q4.
And how well those new subscription products like MultiBurn actually sell.
Exactly. Those things have to work to validate this whole multi-year story of sustainable growth. They need to prove the digital investment actually boosts distributor productivity and brings in recurring revenue.
And you mentioned something about debt timing earlier. A catalyst.
Right, that high-cost debt they restructured last April, it has a 2-year no-call protection.
Meaning they can't refinance it until
April 2026. Starting then, they'll actively look at refinancing that expensive debt. So if Pro2col works, if EBITDA holds up despite the FX lag, that date becomes a major potential catalyst for the stock to re-rate.
Interesting. Okay, let's move to our closing segment. And the usual disclaimer. This is not financial advice.
Definitely not.
We aren't recommending any trades.
Yeah.
This is purely a high-risk, high-reward thought experiment based on everything we've just discussed.
Okay, let's float an idea. It's bold, maybe outrageous, but plausible, perhaps?
Go for it.
So the core thesis is Herbalife is making a huge strategic shift, trying to deleverage, all while its stock is near multi-year lows.
And its sector, consumer staples, is lagging. The macro picture isn't great for them.
Exactly. So the idea for someone really speculative,
Yeah.
a paired trade, designed to hedge that broader sector weakness while capturing potential company-specific upside.
Okay.
You'd short the overall consumer staples ETF, the XLP. That hedges against general macro softness in the sector.
And then,
Simultaneously, go long Herbalife equity.
so the bet is?
The bet is that by April 2026, when that refinancing window for the expensive debt opens up, the market will finally have to recognize a couple of things.
Like what?
One, validated EBITDA consistently staying above that $640 million mark. Two, a successful rampant adoption of the Pro2col platform through Q4 and into early 26, driving subscriptions.
And that combination forces a re-rating.
That's the theory. A dramatic re-rating against its currently depressed valuation. It's really a bet stretching over a year, maybe more, that their operational execution finally wins out over the sector headwinds.
That's definitely thinking ahead. Okay, so let's quickly recap our deep dive on Herbalife Q2.
Yeah.
Strong EPS beat, raised full-year EBITDA guidance mainly on efficiency, which the market seems to be discounting for now.
Right, because the slight revenue miss and ongoing volume decline triggered immediate skepticism.
So the entire story really hinges on whether Pro2col and the new subscription products like MultiBurn can actually reignite sustainable volume growth.
They have to validate this new identity as a digitally augmented platform.
So what's your final thought for our listeners?
It's this. Management said explicitly, for the first time in 45 years, they have granular data, those 140,000 data points on how customers and distributors use their products.
Unprecedented insight for them.
Into what was always a high-friction, high-churn model. So the question is, how fast can they actually use that rich proprietary data? Can they turn it into better products, better distributor productivity, better customer retention quickly enough?
To prove this new era is real, not just talk.
Exactly. Is it financially sustainable or just aspirational? That's what we'll be watching.
It's definitely a race against time and history for them. Thanks for joining us for this deep dive into digital transformation in the direct selling world.
Yeah, fascinating stuff.
We look forward to exploring the next set of sources with you soon.